Welcome back, my awesome people. In today's episode, I will be showing you how you can make extra money without putting in any extra physical work. Why wait for your job or your boss to give you a raise? Why not give yourself a raise whenever you want by buying income? Do you need to build a portfolio that will generate you cash? Do you need an additional income stream? Do you have your money sitting in your bank account and not making you any money? Maybe 0.1% in interest? If so, you should consider using an investing technique called income investing. Income investing is the practice of designing a portfolio of investments that will give you a passive income that you can actually live on. And it's important to consider which types of assets will allow you to meet your passive income goals while understanding some common dangers that can affect an income investing portfolio. The art of good income investing is gathering a collection of assets such as stocks, bonds, mutual funds, and real estate that will generate the highest possible annual income at the lowest possible risk. Most of this income is paid out to investors quarterly or monthly, and they can use the payouts that they get in their everyday lives to buy clothes, pay bills, take vacations, pretty much whatever they want, including reinvesting that free money. Naturally, income investing is popular with those at or nearing retirement. When you are retired, you depend on a steady flow of income to replace the income that you once had when you were working your 9-to-5 job. Though income investing is popular with retirees, it's not only for retirees. Income investing can be a strategy for any investor seeking a stream of income from their investments. Like me! Many people I have spoken with have always considered saving money as an investment, but that is totally wrong. Saving money and investing money are two different things, though they both serve your overall financial plan. Even if you have a diversified income investing portfolio that generates lots of cash each month, it is still vital that you have enough savings on hand in cash in a risk-free FDIC insured bank account in case of an emergency, because you wouldn't want to sell your stocks to pay for an emergency, right? Funds saved in a bank account are liquid and can be quickly withdrawn if needed. When all your funds are invested, your capital is tied up and you can be forced to liquidate your positions in order to get cash. Doing so can negatively affect your returns and tax efficiency. You should wait to begin investing until you have built up enough savings to be comfortable about emergencies and expenses. Only then should you start investing. When you build your income investing portfolio, you are going to have 3 major sectors of potential investments. And these include dividend-paying stocks, which are companies that pay a portion of annual profit to shareholders based on the number of shares they own. Bonds, which can be government bonds, agency bonds, municipal bonds, saving bonds, and so many other types of bonds. And real estate, which you can own physical properties outright or invest through real estate investment trusts, also known as REITs. Real estate has its own tax rules, and some people are more comfortable because real estate offers some protection against high inflation. A closer look at each category can give you a better idea of appropriate investments for income investing portfolios. Did you know that identity theft is the fastest growing crime in America? There's a new victim every 14 seconds, and investing in any cryptocurrency requires a lot of your personal information to be shared with different crypto exchanges, crypto gaming platforms, and crypto purchases. Your personal information and identity can be shared and stolen by anyone online and even sold to the dark web. I personally have been a victim of a phishing scam a few months ago. It was an email that looked and sounded exactly like one of my employees, but guess what? It wasn't. I clicked on the link and a few days later, I received various emails from various subscriptions that I subscribed to claiming that I have changed my passwords when I did not. And believe me, this was a scary moment. Thankfully, I had the Aura app, and this saved me big time as the Aura app searched everywhere on the web, including the dark web, for my personal information and was not only able to alert me, but I was able to cancel my subscriptions without any further damage to my personal identity. Those who have had their identity stolen are often shocked when it happens. Imagine trying to log into your email account one day only to see that password had changed hours ago. And then you start getting notification of activity from your bank, credit cards, crypto accounts, etc. That's scary and unfortunately a reality for too many people, including myself. And that's why I am excited to partner with today's sponsor, Aura. Aura is an easy to use app that includes everything that you need to stay safe online. Aura protects you from scammers and hackers by scanning the so-called dark web, where criminals sell stolen information looking for your emails, passwords, and social security numbers. It alerts you fast if it finds anything. They help you fight back against those annoying websites that make your personal information public by automatically requesting removal of your information. This helps reduce robocalls. Aura gives you near real-time alerts on suspicious credit inquiries, like if someone was opening a loan or credit card in your name. Their VPN allows you to stay anonymous online by keeping your browser history and personal information safe and encrypted. And they protect your devices from viruses, malware, spyware, and more, so the bad guys can't break in. Aura even helps you manage what your kids can do on their devices. You can restrict specific apps, set screen time limits, and even set focus times to ensure your child is doing their homework instead of binging YouTube. And their password manager lets you store and access your online passwords securely and conveniently. Maybe you already have an app that does one of these things, but with Aura, you don't have to download and pay for 7 separate apps. Let Aura do the hard work of keeping you safe online. If you sign up right now, Aura will give you a 2-week free trial with my link. You'll be shocked at how much of your private information Aura finds exposed over those 2 weeks. So go to aura.com/Jacob Rant. Again, aura.com/Jacob Rant to start your free trial. Also linked below in the description, or just scan the QR code. So, dividends. In your personal income investing portfolio, you'd want dividend stocks that have several characteristics. You'd want a dividend payout ratio of 50% or less, with the rest going back into the company's business for future growth. A reliable dividend yield, so if a business pays out too much of its profits, it can hurt the company's profit margin. So a dividend yield of between 2% and 6% is a pretty healthy payout, and the company should have generated positive earnings for at least the past 3 years. At a minimum, at least, a proven track record of increasing dividends and a business return on equity, also called an ROE, which is after-tax profit and its debt-to-equity ratio. Return on equity and debt to equity should be healthy when compared to industry peers. This can provide a bigger cushion in a recession and help keep dividend payouts consistent. But on the other hand, bonds. Bonds are often considered the cornerstone of income investing because they generally fluctuate much less than stocks. With a bond, you are lending money to the company or government that issues it. Bonds are safer than stocks, but are still not risk-free. Some bond characteristics that you will want to avoid include lengthy bond durations, as you typically shouldn't buy bonds that, mature in more than about 8 years, because they can lose a lot of value if interest rates move sharply. And risky foreign bonds. Stay away from those. You should definitely avoid foreign bonds because they pose some real risk unless you understand the fluctuating currency market. And finally, real estate. If you know what you're doing, real estate can be a great investment for those who want to generate regular income. That's especially true if you're looking for passive income that would fit into your income investing portfolio. Your main choice is whether or not to buy a physical property or invest through a real estate investment trust. Both actions have their own advantages and disadvantages, but they can each have a place in a well-built investment portfolio. One major advantage of physical real estate is that if you are comfortable using debt, you can drastically increase your withdrawal rate because the property itself will keep pace with inflation. This method is not without risk though, and you shouldn't just put 100% of your investments into property. If the real estate market falls, the loss is amplified by leverage, the use of debt to finance your real estate purchases. Physical real estate requires more work than stocks and bonds due to maintenance, taxes, insurances, and more. On an inflated adjusted basis, the long-term growth in stock values has always surpassed real estate, but many others may disagree. So Jacob Rant, what are you doing to buy income and give yourself a raise? Well, as you know from my many videos, I am a heavy dividend investor. I love my high yield stocks and my REITs. I have not gotten into bonds, and nor will I get into bonds, as I like to control my investments without tying it up for years and years and years. But for other investors, bonds could be a good option. A few companies that I am enjoying the benefits of dividends include FEETHY, BTCY, Smart Center, Iron Mountain, and Sienna Retirement Residences. So if you are willing to take risks, you may allocate more of your portfolio towards stocks and real estate. The higher risk you take can potentially lead to higher rewards. If you are afraid of risk, you may want to allocate more of your portfolio to bonds. They are less risky and offer lower returns as a result. There is no one-size-fits-all portfolio. And remember, milestone people, just like all the information I mentioned in my videos, please do your own due diligence because I am just a clown on YouTube. Stay ranting!